Well, there's a business outlook from some of Australia's most senior chief executives, but today the big economic story was the wage price index, which came in at 3.3%, as we've said, lower than market forecasts. It goes against the notion that wages will rise with inflation. To discuss this, we're joined by Paul Bloxham, Chief Economist of HSBC Australia, former economist with the Reserve Bank as well. It was a surprise, there's no doubt, because if inflation is rising, you kind of tend to expect that wages will follow. No price wage spiral here.
It seems that's the case, yeah. I mean, there was a downside surprise to the market, to the RBA as well. I mean, the RBA had talked a lot in the last couple of weeks when we heard from their statement and after their first meeting for February for the year. You know, they talked a lot about, firstly, the inflation risk, and true, it's in inflation, but they talked a lot about the idea that their own liaison program with businesses was saying that, you know, the wage pressures are really starting to pick up, and that's a risk factor that they're watching very carefully.
OK, can I ask a question about the way, the methodology in which the Australian Bureau of Statistics collects this data and whether it's seeing something that maybe is not being seen in the real world? I'm just wondering here, because we had Employment Hero here, which actually taps more than 1.6 million pay packets directly, saying that they think wages inflation is at around 8% somewhere. So this sort of flies in the face of what others are seeing.
Yeah, there are lots of measures out there, and I think it is a point of contention. But this is the broadest of measures. It's the put together by the Statistics Bureau. It's fairly comprehensive as well. I mean, today's figure wasn't just the headline looking a bit weaker. The private sector bit of it looked a bit weaker. If you look in the detail, you find that in the quarter itself, those people who got a wage rise, well, that wage rise was lower than it was last time around. So through Q3 last year, it was running at 4.3. Now it's running at 4. So it's quite across the board in these figures that wages growth lost a bit of momentum in the fourth quarter.
And even though you can start to see it on this chart here starting to rise, it's certainly not rising in the way in which it has in other parts of the world. And this, given the fact that we've got labour shortages here, this again sort of almost flies in the face of, what the data is actually showing us.
Well, first it shows that it's not gaining momentum right now. In fact, it slowed a bit into the fourth quarter relative to the third. But the level is the important thing as well. It's running at 3.3. The RBA has told us that they are perfectly comfortable with wages running at 3 to 4%, that's consistent with their inflation target. So it's not yet at a level that should make the RBA uncomfortable, and the signals in there are that we haven't really got a price-wage spiral getting going yet. And at the same time, we know the unemployment rate has also now started to lift a little bit. It rose in January. So this is all heading towards the idea that the RBA may not have to do too much more.
But what's your feeling? Do you think that they will, regardless of all that, just keep on going and do a bit more?
Well, so it's very difficult at the moment. The economy's got so many moving parts. But my sort of basic premise in terms of the way the RBA will operate is I think they will need to see signs that both inflation has peaked and the unemployment rate has troughed. And when both of those things have arrived, and there's a debate around those January figures for the unemployment rate, but if the next one is still telling us that it's past its trough and we get clearer evidence that inflation is coming down, it hasn't come down yet, then I think at that point they will choose to pause. Now, whether that is in time, I don't think that'll be in time for March. We just don't get enough information. It may be in time for April. It may not be until we get to May. But that means that I think a couple more, one more hike, possibly another one. That's about what we should be looking at, because I think we are seeing signs that the labour market's already starting to loosen. Today's figures are in line with that too.
OK, so contrast that with New Zealand, which took no chances in terms of inflation by raising interest rates today by another 0.5%. Its cash rate, compared with Australia's 3.35, is now 4.75%. So we can actually hear from Adrian Orr, who is the Governor of the Reserve Bank of New Zealand, talking about this today.
We need to do the right thing by our remit. The business cycle is such that inflation pressures are very strong and inflation is too high, so the direction of our official cash rate was straightforward. The worst thing that could happen is that people are struggling both through these tough times and with high inflation. It's not an and/or question.
So the real issue here with that is that there is a fundamentally different economy going on in New Zealand as compared with Australia.
There are differences, and one of the fundamental ones is the wages story. So wages growth, as we've talked about in a fair bit of detail, is picking up still gradually in Australia. It's still comfortably at the level it's running at is something that the RBA should be comfortable with. In New Zealand, though, wages growth is running too quickly. It has embedded itself. There are signs of a wage price spiral and inflation is too high. The labour market started to turn, but the RBNZ is taking a take no risk approach where they're really focused on inflation. And we think they are likely to drive the economy into a recession. In fact, they themselves are saying, and have been now for 2 consecutive times, forecasting that they're going to have a recession this year to get the inflation out of the system. The RBA's approach is they want to find this narrow pathway where they don't deliver a recession, but we get enough disinflation. So it is a different
It's
approach.
a different story. OK, they've also got one other issue. We'll play a quick grab here from Adrian Orr about Cyclone Gabriel and the rebuilding effort after that and whether, in fact, that just creates more demand. Have a listen to this.
In time, the infrastructure and community rebuild will add to activity and inflation pressures, especially given the existing capacity constraints in the economy.
So if you rebuild after a natural disaster, does that create more inflation, which means you're going to push your interest rates up higher? Or does it just plunge your economy into a deeper recession?
Well, on net, it is likely to be inflationary because if you think about what happens initially, there's a very sharp shock to demand and supply. And then you start rebuilding and demand starts to lift, but supply is being constrained because all of the capital stock or some of the capital stock's been damaged. So you can think about all of that, yes, as likely to be on net inflationary. And that's the way the RBNZ's interpreted it too. It's a very orthodox way of interpreting it. But there's a lot of moving parts here.
Oh.
I mean, they've jammed the brakes on. As you say, they've lifted rates 450 basis points in the period, and they're still waiting for the full effect of that to come through. And, so there's a lot of moving parts.
It's going to be interesting.